I'm Keith McCullough, and welcome to our Investing Summit. This is one of my favorite times of the year where I get to have timely and topical conversations with pros who would know. This pro-to-pro conversation thing seems to be quite practical. Apologies for the delay. It's kind of like people coming to realize what the pump tariff plan really was going to mean. A little late, but it still mattered, and she definitely still matters. Stephanie Pomboy is leading off here today because she's one of my faves and one of the few who actually has any credibility, i.e. a track record, nailing economic slowdowns, declines, market calamities, going back. I'm not going to count the years, Steph, but enough years that matter to me.
Please don't. Please don't. I feel old enough already. And these wild markets aren't making me feel any younger, I'll tell you what. Oh, man. But great to be with you. There's so much to talk about. I guess had I known when I agreed to do this that we'd be doing it against this backdrop, I might have had second thoughts. But here we go.
Well, you know, I think most people would like me to start with tariffs, so I won't. I want to start with where there's actually been a lot of money made between both you and I, and that's partly why you're leading off, and that's actually being long gold. Yesterday was an opportunity for people who didn't buy gold to buy more of it because it was actually down for once, you know, and down like on a day of consequence. You get a lot of people are like having these panic attacks on when they should buy the U.S. stock market. One, they already own it. Two, they don't own gold, generally speaking. But you've done a lot of work on this. You've owned it for a long time. Can you let's start with that, and we'll obviously you can weave tariffs into it or out of it, however you want.
Okay, well, I guess my interest in gold has been a function of a variety of things. First and foremost, being this sort of long-term trend away from globalization toward, people call it different things: mercantilism, isolationism, the shift from unipolar to multipolar, however you want to describe it. The investment framework in which we've all operated for the last 4 decades, this sort of post-Bretton Woods environment where the US consumer was the center of global trade and everyone else was sort of slavishly lending us money so that we could buy their goods and then recycling that money back into the treasury market as a means to sort of vendor finance US consumers. That whole thing has been receding as a theme for a while. And obviously that trend just was kicked into overdrive with Trump and the America First agenda and the tariffs as part of that. So I think the fact is, and the reason I've been bullish on gold for so long, is that this globalization era that was kind of kicked off with Reagan and the fall of the Berlin Wall has been ending and kind of in its dying fits for years now, and that has been manifest in this de-dollarization by global central banks, which again really ramped up with Trump's inauguration. Well, I mean, it really ramped up first with the weaponization of the dollar by freezing Russia's reserve assets, but then it hit another kind of overdrive with Trump and the shift to sort of protectionist policies, which makes the dollar even less relevant on the global stage. And if you believe that, then sort of the inverse of the dollar is gold. And so it is kind of gaining primacy as a global reserve asset. So that's sort of the overarching framework that led me to gold. And within that, there are cyclical things. And I think what we're seeing right now is a sort of combination of the secular and cyclical forces together. And the cyclical force, I would argue, is that the economy has been in recession. That recession has been masked by fiscal stimulus. And much of it last year, people don't realize that there was a significant amount of stimulus that was sort of pre-programmed to hit last year ahead of the election to kind of grease the runway. And that helped sustain economic activity in the face of these higher interest rates. So my sense is that the US consumer and the average business out there has been in recession, and it's been masked by this fiscal stimulus, and that would lead to a risk-off position in asset markets. So you'd start to see earnings downgrades, et cetera, as people realize that the underlying economy wasn't as strong as they were given to believe, and that in a risk-off environment, gold is a safe haven, and so it would benefit from that as well. And then finally, we have seen things mechanical relating to the gold market, which is just, sort of icing on the cake for gold, is this tremendous shortage of physical relative to the paper claims against it. You could do some back of the envelope calculations. It's really hard to come up with hard numbers, but the amount of gold that's traded daily in the paper markets is about 20 times the actual physical available for delivery. So what you started to see with this threat of tariffs was there was concern, misplaced, I believe, that gold would be subject to the tariffs, and that led people to rush to try to bring in physical, and you discovered this shortage of physical available for delivery, and that was a catalyst for another move up in gold. So I think we've got sort of a perfect storm of things, from the secular framework to now the cyclical overlay with the recession, or economic pressures at least unfolding and starting to hit risk assets. And then finally, this market situation where you've got a real dearth of physical gold available to support the enormous amount of paper claims against it.
Yeah, as only you would. So she tidied that up in a nice, really a 3-point thesis for you. So you got the secular, you have the secular, and you have the market structure. Yeah, market structure is a big problem for a lot of things, but gold's been a huge recipient of that. To your point with paper gold, GLD, for example, trading well inside of where the actual physical capacity has been. But on that, let's start with the secular first, Steph, because you've done a lot of work on this. I'm not sure if we're able to show Steph's charts, but one chart that she likes to show is the U.S. dollar as a percentage of foreign currency reserves in the world going all the way back. Right now, if we look at the dollar as a percentage of reserves, that's one thing. If you consider gold, like I do, a currency, that's entirely a different thing. So can you walk through that and how you've talked about that de-dollarization, or however you want to depict that from a long-term secular perspective?
Well, I think of it as really being challenged by our serial monetary debasements.
Yes.
Really, we had this, I'll oversimplify, but basically the U.S. consumer was the engine of global growth for years following, the ushering in of the globalization era under Reagan. And it really hit a apogee, let's say, during the housing bubble, where consumers were spending money like crazy because, their homes were worth so much on paper. And so that really was, I would say, the peak in this whole U.S. consumer as the engine of global growth, and therefore the primacy of the dollar as a reserve assets for global central banks. And what happened was, obviously, after that housing bubble bust, consumers, those of us who've been around long enough will recall, they went into the fetal position for years. Like, they were so burned by that experience of leverage in reverse that they didn't, they wouldn't take out credit card debt, they wouldn't touch a mortgage, they wouldn't touch an auto loan, they just kind of swore off debt for a while. And that was reflected in, that recession that we had that was very deep and severe, because consumers just didn't have the wherewithal to spend the way they were previously when they were borrowing everything. And so that, I think, really was the beginning of the end for globalization. And you started to see not just central banks diversifying away from the dollar because they weren't doing as much business with U.S. consumers who were at that point, hunkered down, trying to dig out of the hole they were in. But also our monetary response to that crisis was so, let's say, feckless in terms of instituting quantitative easing, which is a glorified way of saying, we're going to debase the hell out of the currency. And the money that you're lending us, we're going to pay you back in increasingly worthless paper. That really accelerated the exodus out of the dollar. And this, again, I'm talking about 2008, 2009. So this isn't a new theme. It's just been unfolding glacially in the background. And so if you look at that long-term chart of the US dollar share of global forex reserves, I mean, it's been really decelerating. It hit a peak around, preceding that financial crisis, and then has really been declining since then. And obviously, if you're not going to recycle your incoming reserves back into dollars, you've got to find other places to put it. And aside from gold being a currency, as you said, Keith, and I totally agree with you that that's the oldest currency in the world, it also is conveniently priced in dollars. Yeah. So if you're a central bank receiving dollars and you don't want to buy US treasuries, you can buy all kinds of stuff that's denominated in dollars. It's a hard asset. You can buy copper, you can buy oil, you can buy gold. So they started to stockpile strategic resources, gold primarily, but you saw countries like China build SPRs as well so that they could begin stockpiling oil, and they use at the margin some of their incoming dollar reserve flow to buy oil and gold, et cetera. So that's sort of the broad framework, and how I analyze gold, again, in that secular framework. And then obviously, there are these cyclical things, and we'll see the tariff the trade war drama is interesting to see in that regard, because you imagine that the global reaction to that is very much like it was to our freezing of Russia's reserve assets, that it's kind of, we're just kind of running roughshod, and their appetite to just tolerate that might not be as high as we imagine it to be.
Yeah, word of the day so far, Steph, is feckless. Feckless Fed. Feckless Fed.
The F words. I like the F words.
I know you Dartmouth girls. You use some dirty language, right? We keep it clean here in Stamford, Connecticut. All right. Now this is who would call the Fed feckless? I mean, I could call it fucking feckless. I mean, these guys are ridiculous. I mean, to assume that this hasn't mattered. I mean. But okay, let's park that in a place that is a very solid parking lot where everybody knows that the cowbell will come, and that's pending, by the way, again, according to the bond market once again, and at least my model, that we're going to just go right back to the same old cowbell. We're going to have the same feckless Fed. Trump's going to encourage it, et cetera, et cetera. We can park that there for a second. But going back to the U.S. dollar as a percentage of global reserves. Now, there's a very interesting part of the chart, if you go back to the 1990s, of course, is when we actually engaged in globalization via free trade, post-NAFTA. The dollar had a huge move, as you well know. I wish we had the chart to show people. Again, guys, if you guys can show U.S. dollar percentage of global FX reserves, and she shows the deficit against it. But all the way up until China joining the WTO, I mean, that was the peak. So to say that tariffs, or to say that not tariffs, didn't perpetuate a dollar all-time high on a relative and absolute basis would be irresponsible analytically, wouldn't it?
Yeah. Well, and the numbers you're looking for before that whole dollar move took off, the dollar was 45% of total forex reserves, and it hit a peak of, I think right now it's 58. Which is down actually from its peak. So
yeah, its peak was like in the low 70% range. Though I mean, it had a massive move between the 1990s and the early 2000s.
Yes, absolutely. So your question is, what happens to go back to that?
Like, I mean, so if you take the Bob Lighthizer view, or the no trade is free, you replace free trade with fair trade. You just actually take, whether you agree with the PTP or not, I call it the pump tariff plan, whether you agree with it or not, they're going to go with it. And going with it is going with something quite different than we've had in the last, never mind 25 years, the last 100 years. So, when I think about when you think of reversing big secular trends that are already breaking down, in the case of, of the US dollar, and you can't take that one out. In fact, the market's probably absolutely nailing that thing. When I'm making money on the long side of the euro, I mean, and the yen, I'm long the euro and the freaking yen. I mean, talk about like feckless. I mean, this is like, this is like doubling down on feckless. But anyway, go for it.
No, absolutely. And this is why I think you and I have both concluded that Powell's protestations to the contrary, it's just a matter of time before they come back and lather, rinse, repeat, do the same thing that they've done every time, because the message of that chart of the dollar's declining share of global forex reserves and this shift to sort of isolationism and tariffs, et cetera, is that we no longer can rely on the rest of the world to finance our deficits. So this is the $1 million question: is if you're going to do this, who's going to finance these deficits? Now, I understand that they're trying to, at the same time, reduce the deficit with Doge, et cetera, and that they're hoping the tariff revenue will help contribute to that. But we're at 2 trillion, we got a massive issue on our hand. And what's interesting about that too is that thanks to Janet Yellen's financing of the deficit, which she did primarily with T-bills, an enormous amount of this debt rolled just in the next 2 years. I mean, we're looking at over 40% of total marketable US debt that comes due between now and the end of next year. So this is, a real problem that we're going to deal with immediately. It's not just some abstract issue that will come down the line. And I don't need to tell you, Keith, about, all the stuff that's going on in the Treasury market. And that's where I think the rubber really meets the road on this is, it's fine if you want to make America first and have an ambitious goal of reshoring manufacturing and securing, pharmaceuticals and things that we need, that we don't want to rely on our enemies around the world to provide us. But you have to have a solution to how we're going to finance deficits that we've relied on the rest of the world to finance for us for years. And how do you do that without destroying the purchasing power of the currency? And that's why I keep coming. But, to me, all roads lead back to gold for that reason.
Well, the good news on that is, actually, like some kind of, I wouldn't even call it a shimmer. I call it a flicker of light is Scott Bessent, at least in rhetoric and in practice. Again, he is of our vintage, I guess, of Wall Street analysts, macro analysts, and portfolio managers who's over the years gotten some really big things right. I think he thinks about the U.S. dollar. I think he respects the purchasing power of the people and talks about it. He's been very quick to say, hey, look, people just got a big tax cut at the pump, especially the people that don't have any money, which is like 50% of Americans, where that really matters. So at least there's a flicker, because Janet Yellen, there wasn't a flicker. That I'd use another word with an F. But it's thank you. The team just showed the chart going back to 2016, but the real peak in the dollar as a percentage of the total shooting match was back in the early 2000s. Another chart to tie this back to what you said. You said a lot there, right? I mean, I think the market structure of gold, plenty of gold bug who's been bullish and bearish, the whole way up and down will tell you that. I think there's plenty of literature for people to confirm that because it's just an empirical fact. But on the impact of the U.S. corporate profit cycle, I think a lot of people miss this, tying tariffs, tying the dollar, tying it all together, as only very few people in this world can tie it together like Stephanie Pomboy can. But guys, if you go to slide 58, and just to get your reaction to this, we call it greedflation, Steph. Which is, again, we're showing you on the left U.S. corporate profit margins at the all-time highs. I mean, coming into this, they were at the all-time highs. Now, it's one thing to say, okay, we're going to make new all-time highs just because I'm a perma-bull, but it's another thing to understand what drove the all-time highs. Right. It is mathematically impossible with a weakening dollar and tariff pressure on the big time come for that not to go down and potentially materially so. And I wonder if people understand that stocks aren't going down because of pump. Pump doing an anti-pump or whatever you would do, like there's some pretty good cartoons we have on that, in terms of the plan and how it reversed, kind of like think of Trump's hair and like kind of doing something into the wind and it coming right back at you. I mean, that's what happened. A lot of people are blaming this because they wouldn't know otherwise. My stocks are going down because because of Trump. It's because the market, if I'm right in just looking at that peak margin picture, is starting to discount lower revenues and earnings for companies, therefore lower multiples and lower stock prices.
Right, absolutely. I actually wrote a whole piece called Scapegoating that talked about this idea that the tariffs are going to be the convenient scapegoat for everything that goes wrong in the markets, when in reality, we're just finally seeing everything that I've been writing about for years now. If the economy was in recession and it was just fiscal stimulus that was masking, it was a matter of time before the earnings were going to evaporate. And in fact, I know you've done this work, Keith, because you're much more micro than I am. But when you went and looked at the composition of earnings last year, I mean, outside first, you started out with just the Mag 7 were the ones that were making all the money, and everyone else was kind of just getting by. I think there was a point last year where 33% earnings growth for the Mag 7 versus 4% for everybody else. I mean, they were really skewing the averages. And then importantly, as relates to the consumer, which is my main focus, if you took Amazon out of the consumer discretionary number, and Amazon makes all their money with AWS, they're not a consumer discretionary stock anymore. I think I would argue they belong in a tech basket, not in the consumer discretionary basket, but be that as it may, if you take them out, consumer discretionary earnings was zero. So they were in recession. So, this whole earnings story that was in theory driving the move in the markets was really just the function of 7 or 10 companies, and the rest of the corporate sector was really struggling. And we know that because we saw the largest number of corporate bankruptcy filings since the global financial crisis. So, and all of this, I think, has been ignored because everyone's so surface and superficially focused on the averages, and they don't drill down into what's going on beneath it and see the disparities within different sectors and different companies. And so I totally agree with you. I mean, the tariffs are obviously going to be a contributing factor for certain companies and industries where it will be, an existential problem or could be a benefit. But broadly speaking, I think the issue here is much broader from the standpoint of earnings. And then I would go, just to underscore that and reiterate the fiscal stimulus role and the role that played in supporting the pass-through of the prices that you were alluding to that allowed the margins to be sustained that much last year. So absent that, you've got to wonder, look at the sentiment numbers, look at the confidence numbers. The consumer is telling you that they're really worried about not just inflation, but their employment prospects and therefore their real income prospects. I mean, the outlook for real income, I think, is the worst in history on the consumer sentiment number. So presumably their willingness to abide higher prices across the board, or even their capacity to do so, is really being stretched. So I think you may see an environment where, again, as has been the case, all the things people can't afford to live without may enjoy a little bit more pricing power, but it will be at the expense of all of the discretionary stuff where consumers say, look, I just can't afford to take that vacation, or I can't afford to buy a new washing machine or whatever the item is.
Yeah, I mean, people have been living pretty large for a while, and in particular if they were hired by the government. I mean, so our deficit didn't come out of nowhere. I mean, Janet Yellen, pin the tail on the donkey, you're it. I mean, there you go. And I'll come back to that. But first, I just want to finish the point on what I affectionately call the Bag 7 stocks and their impact, not just on margins, Steph, but I don't know if you're familiar with Dan Rasmussen or his work on at Verdad, but he publishes a great, for free, right? He runs his own fund. He built it on his own from scratch. He's one of the great success stories. I think one of the great young minds out there that's building a good asset management business. But guys, if you pop the chart that I was showing from Dan this morning, check this out, Steph, right? So we know that the market cap is a function of the growth rates. Like that's what I was long these stocks. I mean, if you can show me an accelerating revenue growth rate in the case that you just showed, both on a relative and absolute basis, which the Bag 7 had when they were the Mag 7, It became 30% of the stock market, right, in market cap.
Wow.
But on a volatility adjusted basis, it's closer to 45% of the stock market, right? So all I really need to know, like, I don't have to have a recession. You and I don't have to have the same forecast on a recession. All I have to know is what is the rate of change of revenues and profits going to do at the Bag 7. I mean, that's going to get me almost halfway right on the whole thing. Do you agree with that?
Yeah, I mean, that definitely has been the tail wagging the dog. And you can go in and look at the performance. You know, I like to look at the whole 500 constituents for the S&P 500 and how many are under or outperforming. And right now, I mean, we're now Bag 7 time. You know, I'm sure the skew was even more dramatic during Mag 7. But, you know, 200 of the 300 companies are underperforming. So they're down more than 11% this year. So that's telling you something.
Well, because they're cyclical. Some of them, well, A, they could be cyclical, right? B, they could have been cyclically a huge recipient, i.e. the U.S. consumer stocks, of government handouts, both printing money and giving you money, okay? I'm going to pay you $25 an hour to go down by City Hall and wave at boats. Okay, people like that job, right? They can be on their Insta all day. They don't really have to work. You know, but the private sector didn't like it. My brother is a McDonald's franchisee. Now he has to pay people $18, $20 an hour like opioid addicts. It's like it really screwed up the labor market. Now, if you could go to slide, guys, just to show to Steph's point on slide 80, because you know, people have a very hard time with macro because they're tourists. They jump from headline to headline, Steph. They will not go back to government's contribution to both non-farm payrolls and GDP growth. Or immigration, for that matter. We put both on that chart. I mean, those are massive Democrat injections into the economy that are now massive tailwinds.
Yeah, absolutely. I mean, I had these numbers, which I think are compelling and in a terrifying way, in one of the things that I sent over, on the amount of debt and stimulus, monetary and fiscal, basically, that was injected into the economy over the last few years, and how much growth we got back for that. And I think the numbers, you know, between the fiscal stimulus and the monetary stimulus over the last few years, like let's say post-COVID, where 25 trillion went in, and we got 7 trillion in GDP. And when you adjust that for inflation, you were like under 3 trillion. So, I mean, that's the worst. It's a divisor. It's not a multiplier. You know, it's really like lighting a match to this money. So I think you're totally right to point out, like, this silent government support that's been out there that was invisibly, you know, driving asset prices, consumer spending, all of it, is now receding big time. And people who imagine that, oh, you know, we're just having a temporary blip and we're going to go back to the way things were, are kidding themselves.
No, it's bananas. I mean, you know, you made the point as well. She's encyclopedic, so I have to show the charts. You know, she gives you the words. People on Wall Street will give you words. You watch CNBC, there are a lot of words. There's a lot of narratives. There's a lot of basically, you know, useless, you know, banter. Okay, people just rant garrulously about nothingness. When somebody actually is a pro, that is, they won't make it on this conversation unless they're like Steph Pomboy. She is encyclopedic. When she says something, it's actually true in rate of change terms. There's a big difference. If you guys go to slide 83, what she said, and this is a function of reality. So this is showing on the left side, you know, salary and wages year over year, which are collapsing. You know, and so you said the expectation is pretty much the lowest it's ever been, but so is the actual reality. You know, you have your so okay. My future is some function of my very recent past. It's a very consistent, wouldn't you say, reality of any diffusion index or anything that you and I measure and map on confidence. You know, like soft surveys.
Yeah, absolutely. I mean, I think if you do a 3-year moving average of inflation, for example, that pretty much is exactly going to equal whatever consumers say their expectation for inflation is. And that's an interesting concept too, because it suggests that even though this spurt of inflation we've had hasn't been really super long lasting in the context of decades or anything, it's been long enough that people are starting to acclimate to it. And so when Powell, for example, gets up in these press conferences and says inflation expectations are well anchored, I wish some of the journalists, quote unquote journalists in that room would be like, what the hell are you looking at that tells you inflation expectations? Are like, are you kidding? First off, your preferred measure isn't even back to your target. Tip spreads are well above where they were trending, prior to COVID. And when you look at any consumer survey, whether it's U Michigan or Confidence or whatnot, all of them show inflation expectations are screaming higher. So I think it's important that people understand, like, expectations are a function of your recent experience.
Yeah.
And that's, we saw that during the housing bubble where people saw home prices going up and they're like, oh my God, I've got to buy 2 and 3 homes because the price is always ever going to go up,
Yeah, it's like, look at these. I mean, I love that. I mean, can you imagine you had like a journalist who actually was competent in the room asking the Fed questions? I mean, this is still America last I checked. I mean, can you imagine if you and I were able to get one question each?
God.
Just one.
It would be fun.
And last I checked, I mean, Pump said that he was going to let stuff like that happen. They just never gave us a buzz. I mean, so we're not going to do it yet. But let's look at slide 50, guys. This is showing you this is inflation expectations. I mean, there's a chart that's breaking out, Steph, and then there are those charts. I mean, these are the University of Michigan inflation expectation charts. I mean, so we put Powell up there in the top left corner, just where he belongs, which,
Right.
He's Pinocchio. I mean, there's absolutely no evidence to suggest that inflation is A, not cumulative on human beings, and B, not expected to be the future. So, they can talk about Pump can talk about eggs all he wants. I mean, he said he fixed that too, but, the aggregate cost of living in America is much higher than what it was at any other time in the modern era.
Yeah, I mean, those charts are literally giving Powell the middle finger. They look like middle finger charts to Powell. But, this is the dangerous thing, is being dismissive of these inflation expectations is problematic when you think about the Japan example, where they became so acclimated to deflation that it was almost impossible to get out of it because you couldn't persuade people that inflation was ever going to pick up. So why would they buy something today that was going to be just cheaper if they waited another month or a year? And that led their economy to be in this mire, this bog of deflation for decades. And so the risk that we have the opposite situation here is real. And I think that creates yet another fascinating conundrum, because we have this sort of, I mean, I hate to use that phrase, the stagflationary waft around here, but clearly real economic activity is decelerating. And yet the inflation side of it is stickier, let's just put it that way, than one would normally expect to see in an environment where real growth is slowing. And so I understand why Powell is trying to maintain the stiff upper lip. I still think it's just good till canceled nonsense, because he'll cave just like he did. I mean, I'm getting flashbacks to 2018. I'm sure you are also, Keith, when he was getting called to the White House daily. So I think it's a matter of time before he caves. But the question is really, like, what's the argument? But then again, what was the argument for cutting rates in September of last year when inflation was above their target and the economy was better than it is right now? I mean, other than the election, which apparently was not a factor in his decision at all, it's hard to imagine any reason why they would have cut back then. So who knows? I mean, the Fed, I just wish that they just didn't exist as an institution, because there are a lot of F words I would like to use to describe the Fed. Let's just say they managed to fudge things up a lot more.
In all of his brilliance, I mean, with Elon Musk, I mean, how he's not whacked the Fed's north of 23,000 employees at the Federal Reserve. I mean, come on, man, that's the easiest cut you can make. I mean, Steph and I would sign off on that. Just because we're running out of time here, I want to, again, doing macro, I really, now everyone who didn't do macro wants to do macro again. Well, unfortunately, you can't actually just start doing it without, Steph's been doing it for 25, 30 years, her and I together over 100 years together. I mean, it's a cumulative process of learning through all of our mistakes. I mean, to not take this entire discussion, I could talk to her for 20 minutes, 50 minutes, 2 hours. You got to tie it together, right? So how do I take the first part, this longer-term dollar devaluation story, this effervescent hope that the Fed's going to do something different for once, which they won't, and how do I take that and not come up with higher for longer inflation in my base case, I have inflation reaccelerating in the back half of the year and into next year, but I don't know where you're at on that.
Well, I think for me, it all turns on what happens to the markets, because nothing cures goods and services inflation like asset deflation.
Yes.
So, we saw this in 2008. People forget, in fact, I'm always, amazed to go back and look that the CPI was over 5.5% going into the global financial crisis before the markets crashed. And 12 months later, it was -2.
Yeah.
So that stuff is very powerful. That reverse wealth effect can really cause massive disinflation. So that's on inflation, I'm so bearish on risk assets that I'm not really concerned about a massive issue with inflation per se. What I worry about is the inflation that comes about as a result of the response to the asset bubble bursting. And that's a conversation I think we can have down the road. But, my sense is that we are going to go back to the same old bag of tricks. And this idea, it's great that we're doing this with Doge and cutting, getting rid of waste, fraud, and abuse and identifying all this fat that didn't need to be there. And that's wonderful. But all of that is going to be a drop in the bucket if we have a 2008-9 style meltdown in the markets and an equally bad recession in the economy as a result. And then the budget deficit will just expand back out by more than the amount that Elon Musk and his crew are able to cut right now. So I think we come back to the same issue. It is the issue for the US economy is how are we going to finance these deficits and how are we going to do it? If we're giving the rest of the world the middle finger, these are the people that used to be lending us the money. And they're now saying, we don't want to lend you the money anymore. We're finding other places to preserve our capital, and protect our reserve assets rather than allowing you to, debase them via your monetary policy. So I think that's really the issue, is how are we going to finance these deficits? And the only answer I could see is the same solution, which is just a matter of time before we go back to quantitative easing, which of course they'll call something different because they can't call it quantitative easing. They'll come up with some other name for it. It'll be, a cross between quantitative easing and yield curve control or whatever. But the point will be the same, and that is that the Federal Reserve will end up being the marginal buyer of Treasury debt. The only other options that I see would be to mandate, public pensions hold some obscenely high number of percent of their assets in treasuries, which you could see they would have a justification for doing if risk assets get sold hard and it's revealed that all these pensions are long all the most toxic corporate credit and, private debt stuff, which I'm sure they are. But I don't know how much that's really going to get you in terms of picking up the vendor financing slack from exiting foreign central banks. So we're going to have to come up with some kind of program to support these deficits, which after a short stint of declining are going to re-expand big time if we have the kind of market meltdown and recession that I see coming.
Yeah, that would definitely knock inflation. It has knocked it down. I think we're at the street low for Thursday's CPI. We're at the street low for next month's CPI. Oil going down 25% in a collapse is definitely going to help with that falling nowcast. Just to finish with a comment, I had a Market Watch. Jonathan Burton asked me yesterday. He's like, well, for all these RIAs, Keith, and all these financial advisors that don't do macro, like, what would you advise them to do now that they missed a lot of this stuff. I said, pay somebody who knows what they're doing for macro. I mean, pay Stephanie Pomboy. I mean,
and you, right? I mean, come on, we can market each other. So, no,
but really, I mean, when people are upset that the people running their money are losing their money, you should ask the people running your money, when I pay you a fee, what do you do with the fees?
Yeah.
Do you get it like a nice lease on a BMW X5, or what do you do? Like, why don't you pay Steph Pomboy? She could have told you, 3 months ago to get the hell out of a lot of this stuff, and a lot more to come. So, so thank you for being one of the few consistent people who times cycles right and market risk right. I know many people appreciate it.
This is a very flattering way for you to say that I'm old and I'm a broken record. I appreciate it, Keith. I'll take it. I am old and I am a broken record, but hey, but I agree with you. I mean, it's refreshing. I think it's really exciting to actually find that people now have to do analysis. It's a word they might need to look up in the dictionary because it's not one they've been familiar with for a long time, but you actually have to do the work. And as I've said about you in the past, you definitely are someone who does the work and you do it every day. So it's a pleasure to be with you. I'm honored. And I hope the rest of the conference is a smashing success, as I know it will be.
Well, I appreciate that. And under no circumstances ever, no matter how many years pass, is Steph Pomboy ever going to be considered old or old wall? We'll be right back with Tier 1 Alpha.